In the immediate aftermath of the Revolutionary War, the United States was less a functioning country and more a collection of fractured, indebted states, completely lacking a unified financial identity. This 1783 North Carolina currency note illustrates the state of early American money. Because few trusted these localized, often worthless currencies, trust vanished, keeping investors afraid and the economy paralyzed. To solve this, Treasury Secretary Alexander Hamilton engineered a radical consolidation called the Assumption Plan. He federalized the state debts, exchanging old, discounted war IOUs for new, liquid U.S. Treasury securities. This policy transformed government debt from a burdensome liability into a tradable, wealth-building asset, establishing the very foundation of the American capital market. By the summer of 1791, the price of these new Treasury bonds skyrocketed, sparking a public phenomenon known as scripomania. Driven by the fear of missing out, ordinary citizens abandoned their shops and farms to chase financial returns, desperate to profit from the rising prices they saw around them. At the center of this frenzy was William Duer. As the former Assistant Secretary of the Treasury, Duer was the ultimate insider, and he quickly spotted the vulnerabilities in this new, explosive market. He entered a dangerous vacuum, a market flooded with fresh liquidity, but operating with zero transparency and no oversight rules to protect the public. Hamilton's attempt to build national trust had inadvertently engineered the perfect environment for unchecked greed and catastrophic risk. Duer's syndicate attempted to corner the U.S. bond market using time contracts, controlling massive amounts of securities with a tiny fraction of upfront capital. To fund this, Duer borrowed $3 million from merchants, widows, and laborers, promising interest rates he couldn't actually sustain. When private loans failed, Duer embezzled hundreds of thousands from the Society for Establishing Useful Manufactures, draining state-backed capital intended for industrial infrastructure. These maneuvers built a towering pyramid of systemic risk. The entire structure was now completely dependent on bond prices continuing to rise. This overextension did not go unnoticed. A bear syndicate of political rivals recognized Duer's vulnerability and initiated a coordinated short-selling attack to drive prices down. The bears executed a fatal secondary move, withdrawing massive quantities of physical gold from New York's banks. Because banks operated on fractional reserves, this sudden drain forced them to halt all new lending and call in loans, freezing the entire credit system. By removing the hard cash that Duer needed to roll over his debts, the bears transformed his aggressive market bet into a mathematically inescapable trap. In March 1792, credit dried up. Duer defaulted, triggering a violent contagion that wiped out a quarter of the market's total value in weeks. The crash triggered a total illiquidity crisis. Even investors holding high-quality assets were ruined because there was no cash in the market to buy them, ultimately driving Duer to seek safety from mobs in a debtor's prison. Alexander Hamilton faced an existential choice. He had to allow reckless speculators like Duer to fail, yet he needed to protect the solvent banks to save the nation's fragile credibility. He implemented the lender of last resort doctrine, using public funds to buy bonds while instructing banks to lend freely. However, he imposed strict conditions. Borrowers needed high-quality collateral, and they had to pay a steep 7% penalty rate. This surgical intervention arrested the panic. By punishing bad actors while injecting vital liquidity, Hamilton essentially put a floor under the market and restored public trust. The aftermath was a brutal reallocation of capital. Retail investors and over-leveraged aristocrats alike lost everything as their assets were liquidated. In contrast, smart money players like William Bingham exited the market before the peak. When the crash hit, Bingham used his massive cash reserves to buy up distressed assets at fire sale prices, engineering a massive transfer of wealth. This chaos convinced New York's financial community that they needed to self-regulate to survive. In May 1792, 24 prominent brokers gathered under a buttonwood tree on Wall Street. They signed the Buttonwood Agreement, establishing a closed clearing network and fixed commissions. This document resolved the trust gap between brokers and birthed the New York Stock Exchange. However, Hamilton's rescue created a long-term problem: moral hazard. By acting as a buyer of last resort, the government inadvertently signaled that if a system becomes too fragile, the state will inevitably step in to save it. The Panic of 1792 established the cycle of rapid credit expansion, leveraged speculation, contagion, and central bank intervention. This sequence remains the exact blueprint for every modern global financial crisis today.
Thanks for watching. Please subscribe to know and learn for the historic events of the time.